It struck again. Without warning, without a headline, without a press conference, silver prices dropped sharply, and millions of investors were left staring at their screens asking the same question: what just happened? There was no sudden economic collapse, no surprise inflation data, no geopolitical shock, yet silver sold off hard. This was not chaos, this was not panic, this was mechanical, predictable, and built directly into how modern futures markets operate. If you don't understand this mechanism, silver will always feel like a trap every time volatility rises. What really happened had almost nothing to do with silver itself, and everything to do with leverage, margin, and forced liquidation behind the scenes. The Chicago Mercantile Exchange quietly raised margin requirements on silver futures, and that single technical decision triggered a chain reaction that wiped out leveraged traders in hours. To understand why this matters, you must understand how futures markets really work. Futures contracts are not investments. They are leveraged instruments designed for hedging and short-term speculation. When you buy a silver futures contract, you are not paying the full value of the silver. You are controlling a large position with a relatively small amount of capital, called margin. This leverage amplifies gains, but more importantly, it amplifies losses and gives the exchange the power to instantly change the rules when volatility increases. Margin is not fixed. It is adjusted dynamically based on perceived risk. When prices move too fast, the exchange raises margin requirements, meaning traders must post more cash to maintain the same position. If they cannot, they are forced to sell immediately, regardless of price, conviction, or fundamentals. This is called forced liquidation, and it is one of the most powerful and misunderstood forces in financial markets. Silver is especially vulnerable to this process because it is one of the most heavily leveraged commodities in the world. In the paper market, there are often dozens or even hundreds of paper ounces traded for every single physical ounce that actually exists. This means price discovery is driven by leverage, not by real supply and demand. When leverage collapses, price collapses, even if physical demand remains strong. This is why silver behaves differently from gold. Gold markets are deeper, more liquid, and less dependent on extreme leverage. Silver, on the other hand, attracts speculators looking for explosive upside, and when speculation builds, margin hikes become inevitable because volatility becomes unmanageable from the exchange's perspective. The CME does not care about silver bulls or bears. It cares about clearing risk and protecting its members. When price moves too fast, it raises margins. This is presented as risk management, and legally it is, but functionally it always has the same effect. It removes weak hands, wipes out over-leveraged traders, and transfers control to those with the deepest pockets. This pattern is not new. History shows it repeating again and again. In 1980, during the Hunt Brothers silver episode, margins were raised repeatedly, collapsing the price. In 2011, when silver surged toward $50, margin hikes came in rapid succession, crushing leveraged longs. In 2020, during pandemic volatility, the same thing happened. In 2021, during the retail silver squeeze narrative, margins rose and silver sold off sharply. Every time the sequence is identical. Momentum builds, speculative positioning increases, volatility spikes, margins rise, forced selling begins, algorithms accelerate the move, liquidity disappears, and price falls far faster than fundamentals would ever justify. Retail traders are hit first. They use the highest leverage, have the least spare capital, and cannot meet sudden margin calls. Hedge funds are forced to reduce exposure due to internal risk limits. Meanwhile, institutions with access to cheap capital step in calmly, absorbing forced liquidations at discounted prices. This is why margin hikes always feel unfair. They arrive at moments of optimism, never at moments of despair. They do not stop silver's long-term thesis. They simply reset the board and remove those who were positioned incorrectly. Silver did not suddenly become less valuable. Global debt did not disappear.
Money printing did not reverse. Industrial demand for silver in electronics, solar energy, and medical applications did not collapse. What changed was leverage. The paper market became too crowded, too unstable, and the exchange pulled the emergency brake. This is the part most investors never hear. Financial media reports the price drop, but rarely explains the structure behind it. Retail investors are left confused, believing silver failed them, when in reality their position sizing failed them. Futures markets are not designed for buy-and-hold investing. They are designed for short-term exposure with strict risk controls, and when those controls are ignored, margin hikes enforce discipline violently. This is why smart investors separate paper trading from real ownership. Physical silver holders did not lose an ounce during this sell-off. Their metal did not vanish. Their long-term thesis did not change. Only the paper price moved, driven by liquidation, not by value. This distinction matters because it determines behavior. Panic sellers react to price. Investors react to fundamentals. Margin hikes punish emotion and reward preparation. They expose who was gambling instead of investing. The uncomfortable truth is that many silver traders are not investors at all. They are speculators using leverage, hoping volatility moves in their favor until it doesn't. The market does not care about hope. It enforces rules mechanically. When margin rises, capital requirements rise, and positions must be reduced. This is why margin hikes always feel sudden, but they are actually predictable. Volatility increases, leverage increases, risk increases, margins rise. This sequence never changes. The only variable is who is prepared and who is not. When you understand this cycle, silver stops feeling random. You stop asking why every rally fails and start asking how leveraged the market is and where forced selling might emerge. This knowledge transforms fear into patience and patience into opportunity, because margin-driven sell-offs often create mispricing. Physical markets often remain tight. Premiums often rise even as paper prices fall. This divergence tells a deeper story about financialization and the difference between ownership and exposure. Silver remains a strategic metal in a world of rising debt, monetary debasement, and industrial expansion. Margin hikes do not invalidate that thesis. They simply clear excess leverage from the system, allowing the market to rebuild on stronger footing. The investors who survive these events are not the most optimistic. They are the most disciplined. They expect volatility. They size positions conservatively. They hold assets they understand. They do not confuse temporary price suppression with permanent value destruction. The market struck again, but this time you know why it happened. You know who was forced out. You know who benefited. And most importantly, you know what not to do next time, because in leveraged markets, this will happen again. It always does. And those who learn the lesson once don't have to learn it the hard way twice.